Good afternoon. This is our May 9th, 2023 episode of Tax Tuesday. Today I'm hosting. My name is Elliot Thomas, manager of the Tax Advisors, joined by what I won't call a guest. He's been on here before. He's one of our more experienced tax advisors, been with Anderson for some time now, Kurt Bergford.
Good afternoon, everyone.
And we are, as our mission is, as Toby talks about, bringing the tax knowledge to the masses. That's the purpose of it, of our Tax Tuesdays. It's where you get to send questions in, and we're going to do our best to answer them. We pick a few of them. We got quite a broad spectrum of things that we're covering today. A little bit, we sometimes get too much into maybe the real estate area or something like that, because we do have a lot of clients asking questions about that. And we certainly have some of that going on today, but we try to expand the questions here into some other areas as well, all due to, we were able to do that because of the questions that you send in. Speaking of which, as far as some of the rules when you bring the questions in, first of all, you can ask them your questions through the Q&A section in Zoom, and we have a dedicated staff to help answer some of those questions. We got, let's see here, we got Dana, who is an EA as of yesterday. We have Dutch, CPA, Jared, Ross, Sergey, Tanya, and Troy, all helping in the background, answering your questions through our Q&A section. You can also email the questions to taxtuesday@andersonadvisors.com. If you need a detailed response, you will need to become a platinum question or a platinum client or a tax client. We try and make this fun, fast, and educational, try and bring some education about tax to you all. That's one of our goals, and we just hope you enjoy the show. And Toby will be back. He's just off today, so no worries there. We'll have our boss and loved leader before long. We're going to, speaking of which, going to Toby's website here for his YouTube channel. Here you can go ahead and subscribe. He's got all kinds of videos. I think we're looking at 500 plus here. And then we have, he's also a best-selling author, of Infinity Investing. His big book, and he covers a lot of that material in some of his videos, as well as other tax items. And so by all means, feel free to join up into his YouTube. All right, getting back to it. Also, here you can subscribe on the YouTube at aba.link/YouTube for our replays, which we'll have here. They will be on our website, replays of the show. I don't think we take these down anytime soon, so I think they're up there permanently, actually, for better or worse. And we can see questions already coming in. And again, we have the staff there. They're going to get to your questions. Please be patient with them. They're trying to get to them all. And we do have typically a couple hundred questions that come in at this time. All right. So on to the questions that were sent in today. All right, Kurt, first of all, is it true that you don't pay capital gains or dividend taxes if you make less than $40,000?
So that's actually a very common question that we get because, it seems like the way it's written, when you look on things, the internet is full of this, hey, if I make less than $40,000, are my capital gains subject to 0% tax? And it's kind of a little nuanced answer. When we look at that $40,000, we want to look at what is that $40,000. It actually says if you make taxable income, if you have taxable income of less than $40,000, your capital gains within that $40,000. Because remember, capital gains income would be within your taxable income. So, for example, say you had $20,000 of wages, and you had $20,000 of capital gain income, that $20,000 of wages would be subject to income taxes, and that $20,000 of capital gain income, because your total taxable income is below $40,000, would be subject to 0% tax. However, a lot of times this gets misconstrued. Say you have, again, that same $20,000 of wage income, but then you have $100,000 capital gain on the sale of a rental property. Well, you just want to make sure that you're thinking about what's actually included in your taxable income. So that's going to include all things: interest, dividends, wage income, capital gains, as I said before. So anything above that, say you had $100,000 capital gain, you had $20,000 of wages, the first $20,000 of your capital gain is going to be subject to that 0% capital gain bracket. But anything above that, you're going to be jumping up to that next 15% capital gain bracket. So remember, there's 3 capital gain tax brackets. There's 0, 15, and then 20. If you're single, anything below with your taxable income below 40,000, before 41,675 or 83,350, if you're a married filing couple, will be subject to that 0% capital gain bracket. 15% will go anywhere between, if you're married filing joint, go between about that $83,000 number all the way up to 517,000. So if you have capital gains within that bracket, those will be subject to 15%. And then if you get over that level, if you're really doing well and kind of knocking it out of the park, anything beyond that $517,000 200 number is going to be subject to that high 20% capital gain rate.
Exactly right. So yes, it's possible you get that 0%, but as Kurt pointed out, there is always an asterisk next to that. So we have to do a little calculating. So you might get some 0 in there, maybe not if you make too much, but it certainly is a real thing. All right, great question. Next, number 2, I've been contributing to an HSA for several years. Can I withdraw funds from an HSA for prior medical expenses without a penalty? If so, how far can I go back? Kurt, got some medical expenses. I got an HSA. These expenses came from several years ago. What can I do?
Yeah, so that's a really good question, Elliot. And we actually get this a lot, hey, I've been contributing for an HSA through my employer for several years now. It just dawned on me that I've been contributing to it, but I haven't actually been getting reimbursed or taking a distribution for those qualified medical expenses that I've been incurring during those years. So the IRS says there's technically actually no limit to how far back you can go with those medical expenses to get reimbursement from your HSA. As long as you have good records, receipts, kind of invoices for going to the doctor, things like that. Keep those, hold on to them. If you don't want to reimburse yourself in any given year, you can just wait on that and get a reimbursement from your HSA in later years. That's no problem.
Very good. So great information there. Next question. Filling out state taxes. What are the pitfalls? Do we have to submit a whole state return if you have an investment in that state? So, Kurt, we got our 1040. We're always familiar with that. That's a federal thing. But what about when we have this state objective coming up here for our taxes? Yeah,
so everyone's familiar with the federal return, and also usually their resident state income tax return. Usually your resident state, you're always going to pay taxes on all your income. Say you live in one state, but you have rental properties in 4 or 5 different states. Your resident state is always going to tax your income always. However, say you live in one state and you have rental properties in 2 other states. What about those states? They might want to tax that income as well. So it might be a situation where, depending on how much income you have in any given state, you might have to file a non-resident income tax return in various different states. Some states will say, like, any gross income as a non-resident, if you're earning any income within that state, okay, gonna have to file a non-resident income tax return in that state to report that income. Other states will say, all right, maybe if you have $1,000 of taxable income in that state, maybe that's kind of the threshold. So you want to really be looking at the state rules specifically for each individual property or business. If you're earning money in any given state, you want to look at those rules very closely. Other types of state and local taxes that we want to be aware of. Certain states that don't necessarily have income taxes. An example of that would be Texas, but Texas does have a gross tax receipt, gross receipts tax. So if you have gross receipts from a business that you're operating in Texas, even if it actually produces no taxable profit after all your deductions. They're kind of looking at your gross receipts to kind of levy some kind of individual tax on those gross receipts. Washington State is another example of kind of things like a B&O tax. What is it? A business and operations tax in
Business
Washington
occupation.
State.
Yep.
Yeah, so other kind of things related to that. California, another great example. The franchise tax, fee. Essentially, it's more or less a tax for the right to do business in California. So if you have kind of income or businesses in various different states, I want to just keep a very clear kind of guideline of what you're doing in those states and what those states' rules are related to the activities that you're doing.
Very good. Yeah. Is it possible to talk state tax without California sneaking in there? Probably not. And I know we have a lot of clients there and always. So yeah, those are some of your pitfalls. 50 different states, 50 different rules. So that's probably one of the biggest pitfalls, I would say. It also is talking to Dutch, who's helping us out here earlier today. And he also mentioned something on some of these bigger investments you might get into, bigger partnerships, perhaps. They also sometimes have a consolidated or a condensed report, 1065 report that they're going to throw out there, where they actually do the withholding for you, which is a little bit different, unique. That will, all that information would come through your K1, but we don't run into that often. But he was just pointing that out as something that's a little bit different on some of the states. So again, lots of states, lots of rules. Thank you, Kurt. All right, let's get on to the next one. Our LLC, it's taxed as a partnership, sold 5 long-term rental properties and acquired 1 new rental property in a 1031 like-kind exchange. The original LLC still owns additional properties. So maybe we had 10 in there, we sold 5, we picked up 1, we got 6 potentially in there. Now we want to move the newly acquired, that's what we call the replacement property or 1031. We want to move it into a new LLC to be taxed as an S corporation for asset protection, makes sense. And because the new property will be short-term rental. All these reasons we want to get into an S Corp is what we're thinking. How soon can we do that, Kurt, without causing any problem with our 1031 exchange? Furthermore, the original LLC and the new LLC shares the same owners and ownership percentage. There's no boot in the transfer. What say you, Kurt?
Yeah, so the issue you're going to come up with here is that you are going from a 1031 transaction from what was presumably a partnership originally into a corporation, and that might be an issue for 1031 purposes. You're not staying with the tenant of a 1031 exchange where you're going from taxpayer to taxpayer, a situation where you're moving properties from one LLC into a new LLC, which is taxed as an S Corp. That's a different taxpayer. That's gonna potentially blow up your 1031 exchange. So we're going to be wanting to be very careful about doing that. And probably that's not going to work too well. But in terms of timeline, we really don't have a timeline here because it's not so much about the time, it's about that you're going from one taxpayer, which presumably is an LLC taxed as a partnership, to another taxpayer, which is not taxed as a partnership, with the same partners and partnership percentages, but instead you're going from a partnership to a corporation. And that's just gonna, again, it's probably gonna disqualify your 1031. So we wanna be really careful about that, but there might be ways to work around, Elliot. Is that fair, to kind of do what the client is trying to accomplish here?
I don't know of any way really to work around that because, as you point out, we have a taxpayer as a partnership. It really needs to receive that property. S corporation is a whole different EIN, a whole different tax reporter than that partnership. Now, we sometimes run across scenarios where we're making reference to the facts that you give at the end here. Hey, we have one LLC with the same owners as another LLC, same percentage ownership, same people, et cetera. But that's usually where you have one partnership and you want to move it into another partnership. That's not what we're doing here. We're going from a partnership arrangement into a corporation. Well, it's an S Corp. It's still a corporation, by at least in some hybrid form. So this is something I don't think we could probably do anytime soon, moving property out there. And furthermore, we're not going to recommend you put property into an S corporation as a general rule, because you never want to put appreciable, appreciable assets into an S corporation for tax purposes. Now here, I know we're doing it as a short-term rental, and that sounds more like an active business. So why not a corporation? Well, again, because it's an appreciable asset and we get hit with taxes later on if we ever want to take it out or something like that, which most often we get to the point where we do at some point. But Kurt, there's got to be something else that we can do to bridge that idea of, hey, maybe I still, okay, I keep it under the partnership in a disregarded LLC, keep Anderson happy. But is there something I can do with the activity of the short-term rental, maybe with an S corporation? Do we got any avenues for me there, Kurt?
Yeah, so actually potentially, because the short-term rental most often is going to be considered an active trader business. So if you're operating that directly out of that partnership, conducting that short-term business directly out of that partnership, most likely the partners of that partnership are going to be hit with self-employment tax. We might not want to do that. However, there might be a workaround. Maybe we can set up a master lease to another S Corp that you have set up. Maybe we set up an S Corp where that partnership actually leases that 1031 property to this new S Corp. And then that S Corp actually is able to conduct the active trader business. Again, the benefit there would be that the actual S Corp is conducting the short-term rental, doing the active trader business, cut down on self-employment tax, take advantage of some of the benefits of the S Corp, accountable plan, maybe 280A reimbursements. That might be a good way to kind of hedge some of that profit in that short-term rental business.
Excellent idea. So we could still keep with our 1031, keep it on our partnership, and then through the master lease, still take advantage of some of that short-term rental activity. As Kurt points out, active business now under an S corporation, use those reimbursements, so on and so forth. Great plan. Hopefully that helps you out on that one. All right, moving on. I recently incorporated myself as a member in my husband's LLC. We decided to be treated as an S Corp. I've heard that we need to determine our W-2 salary based on our level of engagement each of the members have in the business. How can we determine our percentages? We run a residential business in California. He does service part. I do the admin and advertising and bookkeeping. What do you got for us, Kurt?
Yeah, so that's a great question. A common question we get asked. I've heard I got an S Corp set up. I've heard I need to take a wage out. What do I need to take that wage based out on? What are the requirements of that wage, so on and so forth. So yes, it's true that if you have an S Corp and you're a shareholder of that S Corp, you materially participate in that S Corp. The S Corp's profitable in any given tax year, and you want to take distributions out of that S Corp, that yes, some of the income, instead of letting all the income flow through that K1 that S Corp tax return gives you at the end of the year, you're going to have to take some of the income out as a W-2. How much is how much you have to take, and the IRS says you got to take what is called a reasonable salary. So what is reasonable? So reasonable could mean a lot of different things, and it kind of depends on some different factors. But what we like to say oftentimes is anywhere between about 30 to 50% of your kind of cut of the income from the S Corp. If you're working in the S Corp, you're participating, you want to take distributions out, is going to have to be taken out as a salary. So in this example, it looks like husband and wife are kind of running the S Corp. It looks like maybe one member is kind of doing the bookkeeping there, and then the other the husband is kind of doing the service part. You're going to want to take a look at, okay, we're running this S Corp in Southern California. What is a reasonable salary for, if you're doing bookkeeping 20-25 hours a week, what is a reasonable salary for a bookkeeper with kind of comparable technical knowledge, a lot of the same experience that you have? for that kind of role. You know, is that is that 20,000? Is that 80,000? Kind of depending on what you're doing. But take a look at those. You know, you can scope out and go to Indeed.com, maybe go to sites like Glassdoor, Mint.com to get you an idea of what is a reasonable salary for that kind of those responsibilities, that if you were going to go get a job from a third party, you know, doing that same work, how much would you expect to be paid? So if that's kind of in line with 30 to 50%, great. You know, if it's drastically lower or drastically higher, you know, you want to kind of analyze it a little bit further. But if that amount is somewhere between that 30 to 50% range of a reasonable salary, great. You know, just kind of find what a good compensation level for you is, and go through and run that through payroll and pay yourself that amount.
Sounds good. So yeah, S Corporation, we always have that requirement for reasonable wage. If we take any distribution, as Kurt pointed out, might want to look at some online sources to see what does the average person make doing what you're doing, your experience, etc. All good suggestions for getting that wage. As far as your percentage of ownership in the business, that really is up to you to determine. A lot of our clients, if there's couples going into it, they do go 50-50, but that's really up to you to determine the percentage of ownership in the S Corporation. All right, carrying on. I'm thinking of transferring my primary residency into an LLC that I own and turning it into a rental. And can you explain how I should make the transfer so that I can get the 121 exclusion and have higher basis for the property in the LLC? I thought there were some exclusions in section 121 that disallow such a transaction. So I got my personal residence, Kurt. I've been living in it. We got the rules for 121 perhaps coming in here, but I want to turn it into a rental. How can I take advantage? Can I take advantage of 121 and still have it in an LLC as a rental, maybe with some stepped up basis or something like that? What do you got for us?
Yeah, so this kind of poses a unique situation for actually a lot of clients come to us with this kind of similar situation. They've had a primary residence that maybe they bought, 20, 30 years ago at say 200,000. Maybe it's gone up to 850, and with this kind of last market run up, you know, hey, we clearly meet the qualifications for 121 exclusion on a primary residence. We've used this primary residence as a primary residence for at least 2 of the last 5 years. We've owned it for at least 2 years. You know, we want to capture up to that $500,000 exclusion that the IRS allows us to take advantage of with the sale of a primary residence. However, we don't just really want to sell the property. This market is great for renters. You know, is great to rent this property out. We don't want to just get rid of it. It would make a great rental property. We're just trying to do something different in our life. Maybe we can combine these strategies. So in that scenario, what we can do is actually set up an LLC, tax as an S Corp. And remember, Elliot said this before, we almost never put appreciable real estate within an S Corp. This might be the only exception that I know of where that rule, that we get to disregard that rule. So as a general rule, we never put appreciable real estate within an S Corp. However, in this situation, because that LLC taxed as an S Corp is a different taxpayer than us, we can actually sell our primary residence to that LLC taxed as an S Corp. It's a separate taxpayer, so we can actually get the 121 exclusion, that $500,000 up to $500,000 of capital gain exclusion from the sale of our primary residence. And then what happens? We have an LLC that we own. We're the shareholders of it. The LLC taxes an S Corp that we own, that owns this rental property. What did we buy the rental property for? Say we got to buy it for fair market value. So say that's, you know, in this kind of example, $700,000-$800,000, something like that. we've almost excluded most of the gain there, if not all of it. And then the rental property can be rented out to a third-party tenant, and we're able to depreciate the entire purchase price that we paid, that the LLC paid for that, and have a bunch more depreciation. And that's really going to help mitigate some of the rental income, and hopefully that will kind of produce almost a zero tax implication or taxable rental income on that LLC taxes and S Corp.
Excellent. So a little way, a little explanation of how we can take advantage of both the 121 and that stepped up basis. Just a lot of good tax information there. Make sure we're giving it to an S corporation. Just a reminder, we got to pay all that tax in the year that we sold it, but nonetheless, you get a lot of tax benefit here. Get a wipe out maybe up to $500,000 in taxable gain there. Very good. All right, next slide. Just reminding us that we have our Orlando tax and asset protection workshop coming up. It's going to be May 18th to the 21st, as I said, in Orlando. And I believe, Kurt, you're going to be there as well, yes?
Yeah, I'm looking forward to it. Thinking I'm heading there next week. So it will, hopefully the weather is great in Orlando, and if any of you guys on here will be there. I look forward to seeing you.
Get to see the Mickey Mouse and all that too?
Oh, I can't wait. My first time in Florida, so
there you go.
Yeah,
you gotta go.
I got to see Mickey Mouse and an alligator. Those are my two goals for the weekend.
It's his bucket list. You got it right here.
Gotta have
his mouse ears. All right. So as a reminder, 18th to the 21st, if you're around, get down to Orlando, beautiful area, Florida, and you're going to hear from the gurus themselves live. What's going on? You're going to have Kurt there to answer tax questions or just about anything else, and he's going to become an alligator expert for us and bring that all back to us here at Anderson. All right. Carrying on. I was wondering if you could speak about how options, I'm sorry, you're going to handle this one. Yes, Kurt?
Oh, yeah. Okay. Yeah. So next question. Hey, I love the podcast. I was wondering if you could speak about how options are taxed, specifically a credit spread where the profit I receive is only the spread between the leg I sold and the one I bought. Would I pay capital gains on the profit of the spread or the entire premium I receive? I.e., does that option I bought and subsequently expire worthless? Is that considered a capital loss? Additionally, when I sell a covered call, does it lower the cost basis of my stock? It seems that my brokerage displays a lower cost basis. If so, it would seem that the IRS double dips by charging capital gains on the options sold and considers my profit as qualified capital gains. Thank you for your clarity. Much appreciated. So that's a mouthful. What do you say, Elliot?
So yeah, we got a lot going on in this question, and as I said earlier, Kurt and I get a handle an awful lot in the real estate realm as far as questions. Really like this one because we talk about trading structures and things like this, but this even takes us out further into the options world. A lot of difficult context here. Some of you may want to just, if you're just real estate, you may want to just hit the snooze button here for a second, but we're going to go through the best as we can here. First of all, what is an option? Option is simply the right to buy or sell stock at a certain price, which we call the strike price, during a set period of time. That's all an option is. Now here, we're looking at something a little bit different, the credit spread with these options. And what that means is that occurs when you sell an option at one strike price, and then you go out and you buy another one at a different strike price. And we call those legs. Leg one, you go out and you sell an option, the right to sell or buy stock. And then leg two, later on, you go and buy an identical option for the same stock, identical one at a different strike price. So there's some definitions going on there. Now, often if you look at this kind of commentary, they'll talk about netting the two legs to get to what's called a net credit. That's not, from a tax perspective, what the way the IRS looks at it. They look at the two legs independently. And whenever we talk about an asset, stock no different, you have what you paid for it. That's our basis. We're going to have that in leg one. You're going to have a purchase price or a basis for stock two, or for leg two, excuse me, as well, when we purchase the option. In the first one, when we sell the option, I sell an option to Kurt for, let's say he pays me $5 for it, for the right to buy stock at $20. We call that the premium. He pays me $5 a premium. Right now, that's my basis in that first leg. Down the line, if I go out and I buy another option to fill out the credit spread here, then I'm going to pay somebody for that option. Whatever I pay for it is going to be my basis on that second leg. So we know we got these 2 points, we call them legs. We know what their basis is. It's just like if I go out and buy a house, I pay for something, whatever I paid for it, that's my basis, no different here. But now we get to where we're trying to calculate some gains, and it gets a little fuzzy, especially when we talk about the first leg. I think that's probably the most difficult. We're going to handle that first. And the reason it's kind of challenging is because there's different results that can occur. There's 3 different results. So again, Kurt paid me $5 a premium for the right, an option to do something at $20 with his stock. Well, what if he doesn't do anything? We call that letting the option expire. If he doesn't do anything, Kurt paid me $5. I put it in my pocket. It's my money. All I have to do is pay tax on that. Now, it will be short-term capital gains. And this is a unique area in the code where it doesn't matter how long I held that. Even if it was over a year, which typically these don't go that long, but even if it was, it's going to be short-term capital gains regardless. So that's the first thing that can happen on that first leg as far as our taxes. The second is, well, what if Kurt actually exercises the options? Well, now we have a divergent path. It depends on what type of option it was. And we got 2 of those. One, a put option. And a put option is the right for Kurt to sell stock at that stock price and my obligation to purchase at that strike price. Okay, so again, he paid me $5. Strike price was $20. He's saying I got to buy his stock at $20. Okay, well, what we do with that premium is, even though I paid for it at $20, we usually say that's the base. Because I got $5, we're going to lower the base down to $15. Okay, so our new base in this case is a basis is $15. And then if I sell the stock above $15, well, I have gain, capital gain. If it was over a year, well, then it's long term. But what if I sell less than $15? Well, then if I sold at 10, well, I'm going to have a $5 loss, capital loss. That's all we do with the put. But what if it was the other option where we have a call option? And again, a call option is the right for Kurt to buy stock and my obligation to sell him the stock. It's the exact opposite as the put in that sense. And so what we have here, if he exercises that, he's forcing me to sell the shares at $20. But remember, all the way in the back there, he gave me that $5 premium, okay, to buy the option. I'm going to take that $5 and add it to my proceeds from when I sold him the stock at $20. So I got $25. Now, is that a gain or loss? Well, it depends. What did I originally buy the stock at? If I bought it at $22, sold at $25, got a $3 gain. What if I bought at $30 and I'm selling at $25 with that $5 premium? I got a loss of $5. And that's how we determine that first leg of what's going on our basis and whether we have a gain or how it's handled, okay? But we have that second leg, remember, where I went out and I had to purchase an option, okay? Excuse me, before we get to that, we have the third possibility. That was where he exercised the stock, but another is where I go out and I just purchase an option to settle everything. So we call it closing out. And in that case, all I do, if I go out and I buy a similar option, let's say I paid $7 for it. Well, Kurt originally paid me $5. I sold at $7, so I'm out $2 loss, capital loss. Alternatively, if I bought at $3 and I originally got $5, well, then 3 minus 5, I have a $2 gain. So those were the 3 options for our first leg of how we would determine the taxes. Now moving over to the second leg where I went out and bought an option on that second leg. Whenever I buy something, we talked about this earlier, that's going to be my basis. So whatever I bought that option for, if I paid $10 for it, there's my starting basis. Now, later on, I'm going to sell that option. And if I sold it for, say, $12, well, I bought it 10, sold at 12, $2 gain. If I sell for less than that, say $7, well, now I have a $3 loss. But what if I don't do anything? What if I let it expire? Well, remember, I had originally paid $10 out there. I'm out of pocket $10 for this option. If I don't do anything, we consider it as a sell at zero, and so I have a $10 loss. And getting back, when we take that all into consideration, that really is what we're getting at in this question as far as the credit spread. You know, if we look at the legs independently and determine their basis and the gains accordingly, if it expires worthless in the case of the second leg or something like that, if I had to pay out for it, well, then I have a loss. In the case of if I'm selling an option and I just get the premium and it expires, well, then I have a gain. So it'll depend on which side we're on that. Also, when you're talking about the covered call under this section, sometimes you see this lowered basis. We only see the lowered basis typically under the credit spread. As I said, when you get the put option where we take that premium of $5 and we reduce our basis for it. In the case of selling in a call, we're actually going to add it to the amount we sold. So what's actually going on in your brokerage accounts here, I'm not sure why they're changing. There may be some cost of purchasing these things going on or something like that. They're changing it, but that's, to my knowledge, the only time we're going to have an impact on that basis with the premium going on. So we may not be able to exactly help you on why you're seeing a difference, but it has probably something to do with some expenses and things like that. We good to go on that one, Kurt?
Yeah, excellent, excellent.
Okay, everybody can wake up, back up. We're going to get back to something normal. All right, and this came in 3 parts, but they're all relevant and good, so I wanted to hit all 3 of them. Number 1, do you recommend putting a home that will be in a flip into an LLC? Do I want some LLC protection for a flip? What are the tax pros and cons? Can you reuse that same LLC name? Good questions. Number 2, if we buy and hold and decide 6 months later to sell, can we reuse an LLC name? And is the physical address tied to that LLC? I know it will be deeded over to the LLC. In other words, things keep changing. How does one go about making the changes to the LLCs, and how important is it to have an address match the LLC? Wanting to make changes without huge costs being attached. Good question, especially when you're getting started, you're trying to learn all this. Good questions. And then finally, living trust. Do you recommend every new property be included in your living trust? With Anderson, can properties be added or taken out without a huge expense? Would you add homes would you add homes if you're only going to own them for less than 6 months? Any ideas on any of that, Kurt?
Yeah, so let's start with that first one. Do you recommend putting a home that will be a flip into an LLC? What are the tax pros, cons? Can you reuse that same LLC? So yes, if you're going to be flipping, we absolutely do not want you to be flipping out of your own individual name. If something goes bad with a flip and it's in your own name, you know, we want any kind of liability from that flip to stay with that flip in that LLC. We don't want your own personal name being attached to it at all. So definitely, if you're going to be flipping any kind of home, put that into an LLC. I'm going to skip ahead just 1 second. Can you reuse that same LLC name for a different flip? I'm going to say you can, but we're not going to recommend that. That's the same kind of thing where, say you did one flip in one LLC, something went wrong with it, and then you reuse that LLC to do a different flip. Say there's a property, you know, that new flips in that same LLC, some kind of issue comes along with that old flip. Who's going to get sued in that circumstance? That LLC, which now has the new flip in it. You're exposing the assets, that new flip in that old LLC, to the liabilities of the old flip. So we're really going to recommend one LLC per flip. And then kind of skipping back here, what about the taxes? So, you know, that's a very important point. We kind of touched on the liability issues, but what about the taxes? Usually, you know, flipping is considered an active trader business. It's not like holding passive rental real estate. It's not like that. It's you're conducting an active business. And what is the issue with conducting an active trade or business? You might be subject to self-employment taxes on the profits that you make when you do those flips. So usually when we're talking about structuring for flips, what we might do is set up some kind of corporation for you. Sometimes it's going to be a C Corp. Sometimes it's going to be an S Corp, kind of depending on your own unique situations, but usually a corporation of some sort. And then we're going to have an LLC that is going to be disregarded for tax purposes to that corporation. And what that's going to do is any income from that individual flip held in that LLC, instead of filing a tax return for that LLC, that income or loss from that flip is going to be reported on that corporation's tax return. We're going to avoid the self-employment tax no matter what kind of corporation it is. We'll have the additional benefits of certain kinds of corporations. With the C, you'll get health reimbursement arrangements, medical expenses reimbursed. With a C or an S, you're going to be able to take advantage of that accountable plan. All your business expenses can be conveniently reimbursed to you. Maybe take advantage of the 280A, get some corporate meetings in there, and really knock down that kind of extra profit that you have on the flip. So from a tax point of view, that's usually how we're going to do that.
All right. Oh, I'm sorry. Go ahead.
Oh yeah. Okay. I was just going to hop right into number two. I was going for it.
Yeah, no, you can keep going. Yeah.
Yeah. Perfect. So, hey, number two here, if we buy and hold and decide 6 months later to sell, can we reuse that LLC name? And is the physical address tied to that LLC? I know it will be deeded over to the LLC. In other words, things keep changing. How does one go about making the changes to an LLC, and how important is it to have an address match that LLC? Wanting to make changes without huge costs being attached. Very good question. So here, this is kind of a situation where we don't have a flip. We have a buy and hold. Usually with buy and holds, we're going to attach, we're going to put that buy and hold, that rental property in its own LLC. And that LLC is going to be owned by your Wyoming holding company. So say 6 months later, we decide to sell. Can you reuse that LLC? Again, same kind of concept before. You technically can, but we're not going to recommend it because, who knows what happened during that 6 months. Maybe we rented to someone who had some kind of situation, and there ends up being some liability coming back from that property. Do we want to be, unnecessarily jeopardizing any new property that we place in that LLC by the activities that are long gone now? Let's just clean the slate, get a new LLC in there, and go from there. So I don't really think the issue with the physical address tied to that LLC, for example, often we'll do 123 Main Street LLC. If you had a different property name, I don't think that would be an issue. It's more so the liability issue. And so we really don't want to reuse those LLCs that much. So I think that was pretty good. Yeah, again, having the addresses match, not a huge deal. We just don't really want to keep those old LLCs around for asset protection. And then 3, the living trust. Do you recommend every new property be included in your living trust? With Anderson, can properties be added and taken out without a large expense? Would you add homes? You will only own for less than 6 months. So yeah, about that living trust, the way we kind of structure the living trust we set up here, the attorney set up here, the living trust actually will never actually own any of your rental properties, any of your businesses, any of your corporations per se. What will usually happen is your Wyoming holding company, that holds the properties to your various LLCs that hold your rental properties. The ownership of your Wyoming holding company might be placed in your living trust. So that the Wyoming holding company owns everything. all the individual rentals. So when you get a new rental, you're just adding on an LLC to that Wyoming holding company, and the actual ownership of your Wyoming holding company is held within your living trust. Similar to, like, if you have a corporation, like we've talked about before, you're doing the flips with the LLCs, each LLC, per flip kind of thing. Again, none of those LLCs are actually going to be owned by your living trust. The corporate shares, the C Corp shares, the S Corp shares, those might be owned by your living trust. And that's very easy to assign over. Our attorneys on our attorney helpline can help with, if you have a Wyoming holding company and it's owned by you individually, you have a C Corp, and the shares are owned by you individually, you set up a living trust. It's usually a pretty easy transition. Get in touch with our Anderson attorneys, call the helpline. They'll get the right amendments, the redactments, whatever needs to be done to move that ownership of your various businesses over to your living trust.
Wonderful. All right. Then moving on to our to the last question, I think, the second to last. If I'm filing my 2022 tax as an S Corp, which retirement plan should I choose to put my money into my retirement? My CPA told me to put it into a profit sharing plan. We often talk about solo 401ks or something along those lines with the PSP account, which I'm not familiar with. Can I put it into a SEP-IRA? What are the main differences between those two accounts, and which one would you recommend to open? Kurt, any ideas?
Yeah, so, what you really need to remember in this situation is to actually fund any type of retirement plan or contribute to any retirement plan, you're gonna need earned income from the business. Seemed like you filed an S Corp in this situation. Presumably, as we talked about before, if you were profitable within that S Corp, you had to pay yourself some sort of wage. So you're gonna have some amount of earned income. So it kind of depends on how much that was, but you should be able to contribute either to a solo 401k or a SEP-IRA. So a SEP-IRA is going to be kind of your own individual retirement account, where a solo 401k is going to be sponsored by that S Corp. You actually need the S Corp to sponsor that qualified retirement plan, that 401k. So they're kind of very similar in some ways, but there are some differences. And again, you're going to need earned income to contribute to either one, but how much you can actually contribute to either one will kind of depend on either one and kind of how that works. So I think the main idea here is that with the SEP, we're talking about kind of a profit sharing component. It still should be 25% of your compensation, but you're going to need much higher wages to max out that SEP than you would if you had a solo 401k. If you were a solo 401k, you're allowed to first use that fully, the employee deferral, that $20,500 can go for your employee deferral. And I think in 2023, the difference it should be $66,000 total that you can dump into that solo 401k. I think in 2022 it was $61,000 total. So if the first $20,500 goes to the employee deferral, that leaves $40,500 that could go to that profit sharing component. So, when we talk about how much of a wage we need to max out to get to that max, fully fund that retirement plan, you're looking at about $162,000 of wages within within your S Corp to pay yourself a salary of about $162,000, so that you can fully fund that $40,500 employer portion profit sharing component. So kind of when we compare that to what it would be if it was a SEP, you're going to need a lot higher wages. I think you're going to need about 245,000 of wages to max out the SEP. So you might just want to keep that in mind that, you know, with the solo 401k, you're actually able to pay yourself a little less, say, well, I mean, not even a little less, $80,000 less to actually max out that retirement plan. And that's going to be, those wages that you pay yourself are going to be subject to payroll taxes. So when you talk about advantages, disadvantages, the solo 401k is definitely going to save you some payroll taxes if your goal is to max out that retirement plan.
Very good point. Excellent. So, and typically, and I'm sorry if Kurt brought this up, your SEP usually is a more inexpensive plan. So that might be a pro for the SEP-IRA, but profit sharing plans maybe cost a little bit more, but you need to pay yourself less than earned income. And also with if it's one that Anderson sets up, we have quite an open book for what you can invest in, whereas the SEP-IRA might have a more narrow investment world that you can get into, mainly real estate. Some SEP-IRA, excuse me, SEP-IRA plans may not allow for real estate investment. Some might, but I know that our 401k, solo 401ks are quite broad in what you can invest in. Very good points. Thank you, Kurt. All right. Moving on to, I think this is our last question. I heard I can pay my kids to do some work for me without any tax implications. What's the limit I can pay them, and what are the requirements? Kurt, help the parents out there. What do we got?
Yeah, so great strategy. You know, using your kids in your business, you know, put them to work, kind of teach them a little bit about, you know, earning a paycheck, you know, benefit for you. You know, if you pay your kids in the course of your business, you know, that's going to be a deduction, a tax deductible deduction to your business. And also that's going to be income on them. So, you know, the big thing about paying kids is you want to make sure that you're not necessarily incurring a tax liability for them, you know, maybe a tax filing for them while getting the tax deduction. So we want to look at, you know, paying kids. Again, they're going to need to be doing something. They can't just be sitting them around, you know, throwing them on payroll. They really need to be doing something. So, you know, it can be anything, you know, doing yard work, taking out the trash, doing filing, maybe doing the internet market research. I know a lot of kids these days are pretty savvy with the internet. Maybe some of the actual business owners are not as savvy with the tech. You know, get them involved with that. You know, sure, have them start looking up properties. You know, maybe you're into flipping and you're looking for properties to locate. Get them on the internet searching for properties for you. Document their time, document their hours. Treat them like any other employee that you have. Kind of have them on time cards. Get them filling out W-2s. You know, run payroll for them throughout the year. Issue them a W-2. Usually for kids, you know, if we pay them about in 2023, we're looking to pay them probably lower than their standard deduction. So they're going to have gross income of say 13,800. Well, what happens? That's gross income that, you know, usually they would have to pay taxes on, but on their personal tax return, they're going to get a standard deduction. So, you know, in 2023, the standard deduction for them is going to be about 13,800. They get to deduct that off the amount of wages they were paid. And what's their actual income tax liability? Big zero. It's a win for you because you get the deduction and essentially they get tax-free income. You know, maybe you could consider, or maybe they consider kind of using that earned income, that wage that they get paid to fund a Roth IRA or something, get them going for college, getting them kind of set up for, you know, a first home or first business, whatever they want to do. So it's a kind of win-win for the family.
Very good. And that takes us to the end of our questions. Just a reminder, we can get on to Toby's subscription for YouTube. Actually don't know what the address is, but nonetheless, just Google Toby Mathis and YouTube and you'll find it. All kinds of videos out there. A lot of the topics that we talked about today. He's no stranger to all types of tax questions. And we look forward to having him back. But he is out, like I said, for this week. And then I think, again, just a reminder, when you send questions in for us to pick out, you can email us at taxtuesday@andersonadvisors.com and visit us at andersonadvisors.com for our main website page there. Just a thanks again to our staff, Matthew helping out with all the tech part of everything. We got Jennifer G and Alexis running the show, keeping us all in order. And then all those people pumping out the answers for all the questions. We got Dana, Dutch, Jared, Ross, Sergey, Tanya, Troy. Excuse me if I missed anybody. Over 118 questions already answered. They're bringing it. And thank you so much all for bringing the questions. We went all over the tax world today. We had capital gains, state taxes, S corporations. And of course, we had the selling of options and things like that. And then we made it through that one. And then with S corporations, reasonable wages, so on and so forth. It's all because of you sending in the questions. Thank you again. Please send them in, and we look forward to seeing you in 2 weeks.
Thanks, everyone. Have a good day.